Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. I wanted to talk about what's been happening to us all over the last several weeks. Seems like the markets have been making these parabolic moves up, and then they stop and they reverse, and they go parabolically down, and they stop and reverse, and they go back up. And I think some of you might know what I'm hinting at here. We're going to be looking at a chart tool. It's actually called the Parabolic Stop and Reverse, also known as PSAR or parabolic SAR, whatever you want to call it. That's what we're going to be talking about today. We're going to be talking about six different potential benefits that it might add to a trader's efforts to study a stock chart. I think it should be a really good discussion. Very appropriate for today's markets, I think. But in any case, we'll get to all of that in just a moment. But first of all, let me say hello to everybody who's already chatting in. Great to see so many familiar names out there in YouTube. Hello there, Janelle and Kevin, Mill, Sharon, John, Ted, Ocean Life, Barat, Josh, Mary, Life in the Fast Lane, on and on that list goes. Thanks for being here week after week. I really do always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Friday webcast series, and this one kicks off promptly 1 Eastern. We'd love to have you here in our live audience. And just as a special benefit, maybe to attract more people live audience, my very good friend Kevin Horner is going to be hanging out in the chats. Now, Kevin's role here is he's going to be addressing any questions that I can't get to, as long as they're not too far off topic. If I can't get to those during the flow of the presentation, Kevin's there to pick up my slack for me. So thanks for having my back there, Kevin. And Kevin and I would also like to issue an invitation to everybody watching. If you have an account with X, make sure you're following your favorite presenters on that platform. You can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. But it's the best place to connect with me in between these live streams. But let's get right into this discussion of the parabolic SAR. And of course, as we do, we need to consider the risks associated with trading, whether we're using technical indicators or not. There is risk associated with trading, so bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so let's talk about what we're going to talk about. Let's set an agenda for today's discussion. First thing that we're going to do is take a look at our existing and actually recently closed trades. We'll look at those through the technical lenses that we're introduced to, the way that we structured those trades. Then we're going to take a quick peek at the markets to set the stage for our discussion of this new indicator. And then we're going to spend the bulk of our time talking about parabolic SAR. What is it? How is it constructed? How might it be used? And what are six different ways that it might help a trader in their efforts to use a chart to plan and place stock trades. So let's go right to Thinkorswim desktop here. And our first chart here is Marathon Petroleum. This is a position that's already been wrapped up. So let's talk back over this and get a few lessons from this trade. So with Marathon, this is a trade we put back here on April 4th, and it was built using two linear regression channels. We had a 50 and we had a 100 combined with a moving average. Pardon me. No, as a linear regression, I'm a little bit ahead of myself with planning of these trades. Anyway, a combination of two linear regression lines. If you need to revisit the logic of any of these indicators, if you're not familiar with, for example, with linear regression, let me show you. You do have a resource here. Make sure you're taking advantage of it. It's our Trader Talks channel on YouTube. This is where we house previous webcasts. So this is, if you want to go back and watch when we placed this trade, you can go back to April 4th and revisit that trade. But make sure that you pop down below the video stream right now. Click on the subscribe button. It only takes a second. It doesn't cost you anything. But then once you've done that, go to YouTube, do a search for Trader Talks Schwab Coaching Webcast. So you find the channel homepage, and then go right here to playlists. And this is where you can find the playlist for all of our YouTube series, including mine. If I scroll down about halfway. If I scroll to the bottom and then the rest load, this webcast series is right here, Advanced Charting Techniques. I can click on View Full Playlist, and then I can go down to, let's see, this one was the 3 chart tools for gauging and trading stock market extremes. We're asking the questions, have the markets reached an extreme? That's where we found ourselves when we were having this discussion. And were we likely to rebound? Well, this trade was placed based on that premise. Janelle, thank you. You say you share this channel weekly. Appreciate that. But let's go back, not to the slide deck, but to our trade. So on April 4th, what we noted was that we had reached the outer linear regression channel line, which in previous instances had served as a pretty good price floor. So we placed a trade there with a stop. Now that stop, we drew a line on our chart to represent the stop. Then we actually went and entered the stop on Thinkorswim desktop paper money. And we had a target to see if we could return price back up to that linear regression line, which is centered right in the middle of the 2 channels. So a couple of lessons that might be taken from this. Number one is that the stop did its job. It kind of stayed out of the way. We placed our stop just below that lower linear regression channel line, and we got close. Look how close we got. Even the same day, the next day, got pretty close to that stop. We're not stopped out, and then we started this rally, and then it was either yesterday or the day after where we hit our target of 136. That's where our linear regression line was. So we were stopped out at 136, or hit our limit at 136.01 was our execution price. And if we go here to our monitor tab, we can go to the account statement and look at our trade history. There it is. So that was, it was 2 days ago. We hit that, sold at 136.01. So that trade is concluded. Now that leaves us with 2 current positions. We have our now these other ones, these are for other webcast series, but our advanced charting positions, we have AbbVie and we have Amgen. So let's look at AbbVie. Let's go to our charts. This one kind of spurred the discussion, the concept for the last discussion that we had, and it set the stage for placing the Amgen trade. Let's go to our studies here, and I'm going to load up our ABBV ribbon study set. There we go. This was the impetus for this trade. We had a discussion, and you can go find the archive for this webcast, where we covered the ribbon study indicator. And a common signal with the ribbon study is to look for RS1. That's this thickest orange line crossing up above RS2, RS standing for ribbon study. But there are 2 fastest lines on this study, and we saw that we'd recently gotten a crossover, so we took an entry right here. But boy, this is actually, even though we say that these are relatively faster lines, they're not truly fast. They can actually lag behind price by a fair extent, and in this case, you can see price rallied, which is great, and then absolutely collapsed. And you might think, well, obviously we got out. No, we didn't. Nope. With this study, the plan was to stay in as long as RS1 is above RS2, and it's still above RS2. There it is. You can see the pretty good gap still. Now, fortunately, our stock has started to rally, but with that as a backdrop, I decided, hey, let's look at a faster combination of crossover lines and build a strategy set that might be quicker in such a volatile market environment. All right. So with this one, we're still in it. That's where we stand, and we're going to remain in this as long as that RS1 line is above RS2. We'll see if price can recover back up, getting closer to break even, not at break even yet though. But our final position is Amgen. We actually shouldn't be in Amgen anymore. This was the webcast. It wasn't last week. Last week was Good Friday holiday. So it was the week before that where we placed this Amgen trade. So that would have been on April 11th. And here was the logic of this trade. Let's bring up Amgen. And with this, we created a style and saved it. So let's load up our Amgen 20 triangular moving average and 5 exponential moving average. There we go. So it was a combination of two faster moving averages. I don't know if you can quite call them truly fast. That's always in the eye of the beholder. Hey, Van Life, you like that? Thinkorswim has a YouTube channel. Well, Schwab does, yeah. So here was our trade. What we were looking for here was our 5 exponential moving average crossing up above our 20 triangular moving average. We got that signal, entered a trade, bought the shares. With the plan, on that day, we made a note on our chart, sell on a bearish crossover. Now, we didn't know if or when that bearish crossover was ultimately going to develop. So this leaves it sort of up to the trader to pay attention as things are progressing. So this trade was taken on a Friday. This looks like it was days late. No. It was a couple of hours after the signal, maybe 90 minutes after the signal, because this is an hourly chart. Well, just a few trading days later, so this was taken on Friday, on Wednesday, early in trading, there was an exit signal, a bearish crossover. However, we don't have a webcast on Wednesday in this webcast series. This is a Friday webcast series, and we didn't even have it. Notice there's no Friday here on our chart. That's because it was Good Friday. So here we find ourselves 2 weeks after. We are a good stretch, 7 trading days beyond when the trader should have exited. But I don't exit if the webcast isn't going. So, but this should have been a profitable exit had our trader been monitoring their trade closely. So this is where we find ourselves right now. We did get another bullish crossover right here. I'm just going to leave this trade on. Van Life, you like that? Great. I appreciate the subscription. Definitely glad to have you on board. Okay. So that's those are our current positions. So we have one current position, one that was concluded, and one that should have been concluded, but I didn't because the camera wasn't on. So that brings us to, let's go have a look at what's going on with the stock market. All right. Sometimes it's not so fun to look at this if we're looking at this through the bullish lens. Other times it's a little bit more enjoyable. That's kind of the latter right now. So let's switch up our time frame. Let's go back to our 1-year view, and let's bring up our typical study set in this webcast series. And this is not the only way that a chart of the S&P 500 might be viewed, but we use something called the Trend Value Momentum Strategy Set, abbreviated to TVM. Now again, if you don't know the TVM, go to our channel, find my YouTube series here, and you can just scroll down until you see understanding, where is it? There it is. Understanding the Trend Value Momentum Chart Trading System. Okay. So in a nutshell, here's what this strategy set does for the trader. Someone who uses this set of tools might be trying to understand, okay, what's going on with the trend of a chart? Is there a short-term value on that chart? In other words, are we at short-term peaks, maybe overvalued, or short-term trough, undervalued? And what's going on with momentum? So we have our trend indicators, which are a combination of a 50 and a 100 period triangular moving average. We have our value indicator, which is our RSI, and then finally our momentum indicator, which is our MACD histogram oscillator. So what's going on with trend? Well, our 50 has fallen solidly below the 100. This definitely puts a big question mark for traders who use this sort of an approach. They might have a big question mark about the solidity of how solid is this trend. Now, it's been showing some signs of life recently, but yep, still has that question mark hanging over it. However, our 2 shorter term indicators are showing some strength here. The RSI just dipped below our 40 into our oversold value territory, and has recovered. It's back up above 40. That's why this blue arrow is here. And if you're wondering, hey, Cameron, how did you generate that blue arrow? I drew it on there. Okay. But yeah, a sign that value may be present. Prices are starting to strengthen off of lows. And momentum has seen a potentially significant shift. We dipped into red. You'll have to squint. I know. But right there, we got a little bit of a red histogram bar and then shifted back up above that 0 line. So this pair of signals came right around here. signaling that maybe prices are set to strengthen for a while. So who's going to win this tug of war? We have maybe trend versus short-term value and momentum. That might be a tale yet to be told. But one thing that some traders might be looking at, I think you've seen this illustrated probably about a half dozen times in my webcasts in recent days, but also I'm seeing it elsewhere. From that peak down to that low, there's our 50% level. Where are we sitting right now on the S&P? We're finally pushing back up above 50%. Chris says, still looks like a bear flag on the weekly chart. Certainly could, right, Chris? This could just, I can envision that. Down, up, maybe set to break down again. But yeah, it could be a tilting point for the markets right now. Anyway, let me just remove this drawing. Chris, I'm going to take a quick look at what you're referring to on your weekly chart here. That's a possible bear flag. Is that what you're talking about? I might be able to see this move. Let me just make a couple of observations regarding the potential for a bear flag. What do we think? Is this a flagpole right here? And this the flag? I would say no. What would be the fault that a trader might find with this figure as a flag pattern, a bearish flag pattern? A bearish flag pattern is typically interpreted to be, it's historically usually applied as a continuation pattern. That would be a continuation of a previously existing downtrend. What was the trend leading up to this moment? The start of that apparent bear flag. It was an uptrend. So nope, that bear flag is not a reversal pattern. It is a continuation pattern. Now, maybe a little bit stronger case might be made. Let me just clear up my whole drawing set here. Let's zoom in a little bit closer. Could a trader say, yeah, but we came down, we went up, we came down again. That established a low here compared to that low back there, lower low. Here's a high, there's a high, lower high, and then we got an acceleration of that downtrend. And then over the last 2 days, there's our flag. Could that case be made? I think there's a stronger case for that. The one issue I might take with that is that the proportions are a little bit out of whack. You usually don't have a very short flagpole and a gigantic flag. Normally the proportions are the flag itself doesn't come back more than 50% of the flag pole, and this has already done more than that. So I don't know. All right, so let's clear that up. That's just sort of going by, that's sort of a textbook approach to flag identification. Not everybody is perfectly textbook, and there's definitely, there can be a range of opinions in the interpretation of something like that. Okay, so let's go back here. Let's go to our one-day chart. And let's start learning about what we wanted to learn about today. The parabolic stop and reverse, also known as PSAR, also known as parabolic SAR. Go ahead and chat in for me. What I'd like you to do is give me a ranking 0 to 5. 0 means you've never heard of this thing before. 5 means you're expert level with it, you know everything about it. And anywhere in between just sort of describes the scale of experience with it. So if you do that, just chat that in. That would be great. I always like to understand where my audience is. I would suspect there are going to be a whole lot of zeros out there. That's not bad. 0 doesn't mean fail. It just means front end of the learning curve. Okay. So I want to let's use probably a familiar name here, Walmart. Let's clean up our study set. Let's just remove all of our studies so we can start off with a nice clean chart. And I am going to, okay, so I'm seeing a bunch of zeros. There's a 3, there's a 4 out there, a couple of 4s. Somebody says 100. Okay, nice. All right, well, first thing I'm going to add is actually not the parabolic SAR, because this is actually an indicator that's commonly used in combination with other indicators. Maybe most commonly, I don't have data to back up, so I'm sort of speculating here a little bit, but maybe most commonly a longer term moving average. So I'm going to come up here to our little flask icon. Let's add a simple moving average, and let's maybe lengthen that. The default is just going to be a 9-day moving average, very short, very reactive moving average. Let's extend length of our time frame there out to 100 days of data in the construction of that moving average. So this is just, if you're not familiar with a simple moving average, it's a long-term trend line, sometimes used as price floors and price ceilings as well, but a general indication of which way prices are going on average over time on our stock, right? So now let's add our parabolic SAR. So when we click on our little flask icon, we're going to go to the menu. We could go down in alphabetical order down to the P's and just look for parabolic SAR. We could type in para, just type in the keyword and choose parabolic SAR there. And I'm going to add that to our chart and click apply. And what we're going to wind up with is a whole series of dots. Now, I'm sorry, I'm going to pat myself on the back here a little bit. I've covered this one once in the past on this channel, not for this series, but for this YouTube channel. And in my preparations, I always like to see what everybody else is talking about with the indicator. You know, who has good insights? Maybe somebody knows something that I don't. It's an opportunity for me to catch up if I need to. And in my research on YouTube, I couldn't find a single video out there that really explained in detail exactly how this indicator is constructed. I always like to let my audience know how it's constructed to the point that they could go build it themselves if they wanted to. And now I say always. Sometimes I come up a little bit short of that, so always is a strong term. But I do try to be precise, and on this one, here's what I would suggest. If you go to, because I'm not going to do that today. I just don't want to spend the time repeating that because I did it already. But if you go to our channel on YouTube, just do the little search right here. Once you're on the channel, so your screen looks like mine, click on the area that allows you to do a search and just type in parabolic. And you'll probably see Mike Fairborn has also covered this topic. And maybe I didn't watch his video, so he probably did an excellent job too. But right here, trading stock trends with the parabolic stop and reverse PSAR indicator, that one. I went into precise detail so you'll know exactly to the penny how these dots on the chart are constructed. So I'm not going to be repeating like the algorithm that generates the dots. I just want to talk about basically where they come from, what their intended purposes are, and then we're going to talk about 6 ways that they might help with help a trader with their planning of trades on a stock chart. All right, but number one is they're typically used in combination with a trend indicator. Not everybody does. There can be a range of opinions there. So in an upward trend, we might be looking for bullish signals. And in a downward trend, we might be looking for bearish signals. But the PSAR stands for parabolic stop and reverse, and you can kind of see why. It moves, the dots move parabolically with price. They're actually designed to accelerate toward price until they cross price, and then they start moving parabolically in the opposite direction. Parabolic, stop, and reverse, okay? But just to quickly, Eve Interest says, Cameron, is the PSAR one of the indicators you use daily? That is an excellent question. If I were sitting in your shoes, I would want to ask that question every time I saw a new indicator explained by one of our coaches. The answer is I can't tell you. It would be inappropriate for me to say exactly what my approach is to the markets, because when you're someone in my role, if I start talking about the way that I manage my money, it comes with the implied suggestion that everybody ought to do it this way, right? Yeah, I use this indicator. I use this diversification model. I use certain setup in my accounts for the allocation of assets. Can't talk about it. My role is to be an educator. So instead, what I do is I'll just take a tool, I explain really how it works, and then it's left to the individual trader to decide whether that tool is ever going to play a role in their portfolio or not. And I never, to the greatest extent that I can avoid it, try to introduce personal bias into this. So you should not ever be able to read into the way that I present, the way that I do things in my own account. Yeah. Brian says it's just another tool, right? Yep, it's another tool. Whether it has special prominence in someone's portfolio or not, it's up to them. Okay, Janelle, yeah, thank you. All right, so pardon me. Anyway, so let's talk about where a series of dots starts, because we have a series of dots that starts and then it ends, and then another series starts and then it ends, and so on. Well, our series, let's zoom in on some. Let's zoom in maybe back here on Walmart. And you'll notice that this dot, if I draw a line from that dot and I let it intersect with the entire length of the last series of dots, let's bring it all the way back here to the start of this series going down. It always starts at the bottom of the last series when the dots are set to start rising. Now, when the dots are set to start falling, they will intersect with the top of the previous series. So that would go all the way back here, wouldn't it? Yeah. So that's it. So that's how they're generated. So the intention here is that price has actually itself started to rise significantly enough, at least through the algorithm of this indicator, that it generates a new dot. Actually, no, let me back. That's not a good way to say that. Well, no, it's not bad. It's not bad. Really, what's happened here to trigger this first dot is that price has risen up, and you'll see right here, if we were to draw another dot in this sequence going down, it would run into that candle. So our price has started to penetrate up through the downward sloping dots, and it might be a signal that price is reverting or reversing and starting to rise again, and that causes the creation of this first dot. Okay, there we go. That's it. So these dots actually, they're positioned initially below price, but then they're set off racing toward price to try to catch up. So if price is rallying, there's actually an acceleration factor that causes these prices or these dots to rise up faster than price until they catch up sufficiently that if price reverses at all, it crosses over, and a crossover of price over where a dot should be signals a transition, and it signals a new, essentially, trend in our indicator. So I think if you look at the arrangement of these dots, you probably are already guessing how this might be used by our traders. If price is coming down and our PSAR dots are coming down, but then we see a reversal, a stop and reverse where the dots pop down below price, that's actually seen as a bullish sign. The first day that price is above the PSAR, that may actually be a signal. Now, this starts to describe some of the benefits, the potential benefits, because a benefit always is learned after the fact, right? It might look like a benefit at first, but then if the trade fails, it's not a benefit. A potential initial benefit is some clarity into the strength of the trend. Let's maybe outline. Potential benefits. Number one, and we'll make these bold so everybody can see it a little bit more clearly. There we go. Trend clarity. The dots are generally easier to follow. If our dots are going up, the interpretation is that the trend is strengthening, and that can be useful when the candles are kind of struggling at times. So if you look at like this series of candles all through here, that the day-to-day activity got fairly choppy. But for our PSAR trader, they're looking at their moving average is still rising, and on a shorter term time frame, their PSAR dots are still rising, and that it provides a little additional clarity. Now it's possible it can be wrong. It's possible it's not always going to generate profits if the trader is trading on this, but that's one of the potential benefits. Now a second potential benefit is just entry and exit signals. So what are the entry and exit signals? Well, an entry signal is when we have an upward sloping trend line identified using a longer term moving average that coincides with a stop and reverse signal from our PSAR. So as soon as price pops above our very first dot, that's an entry signal. And then the trader maintains a bullish position in that upward sloping stock as long as price remains above our PSAR. Brown Buffalo says, is this similar to a whole moving average crossover script? I can't, it's a good question. I always hesitate when somebody says, is this similar to that? Yes, there can be similarities. Sometimes they're more of a surface similarity, sometimes a little bit deeper. But really, to fairly answer a question like that, it requires literally bringing up both and then showing specific circumstances where one did one thing, one did the other thing, and talking about the different construction of the two. So is it similar-ish? Does it fall within the range of similar? Probably. But I can't answer it in any greater detail than that very quickly. Oh, Jay Richardson says, when price is moving up, do you use it as a stop loss? You're getting ahead of me, but yeah, as a spoiler alert, that's number 3. So, trend clarity, trade signals. The entry signal is price moving above the first dot. Exit signal is actually price moving down below a dot. Now, some traders just say, that's it, I'm out. Others, though, will actually use a trailing stop approach. And a potential benefit here is an automated, not automated, automated trail stop approach. So what does that mean? Well, for some traders, what they'll do is they take the entry and then they have a stop 1% or so. Yep, I can't say 1% is a hard and fast rule because not everybody does that way, but something like 1% below their PSAR value. And if you, let me just hide this left column for just a moment. But if you want to see this PSAR value, you can just point at any given one. And up here in the upper right, you'll see its value numerically displayed right next to it. So where it says parabolic SAR, the 0.02 and the 0.2 have to do with the acceleration factor that's included in the construction of the PSAR, the initial acceleration, the maximum acceleration, that's what that is. But the number there is what might be useful in planning where to place a stop. So for example, maybe our trader took an entry here and they have an initial stop. Where was this? 66, 67. So our stop would be right around $66. Might be right there. I'm drawing an oval, but that's close enough. And then they just move that up, maybe incrementally, maybe every day, as the PSAR value rises. So yeah, that's a good question. Jay Richardson, you say I always give you something new to consider. Well, good. Glad to hear that. Now it's not a recommendation, but consideration is a good word. Anyway, Chris. So George is actually talking with Chris B. Anyway, so in the case that price crosses down and we get a reversal here, it doesn't necessarily always end every PSAR trade. For those that are using a 1% stop, they may just leave that stop. And if price never quite gets down there, and then we reverse and start going higher again, maybe, would this one be an example? I'm not sure. Let's check it. So that was 78.75. Their stop would have been just below 78. I'll bet that little tail right there would have taken them out right there. And then they stop and reverse. So maybe they were out for a couple of days and they're back in. Anyway, so a few potential benefits that we're starting to outline here. We have trend clarity. We have entry and exit signals, automated trail stop approach. This next one can be conceptually applied. Well, actually, probably the next two can be applied to this indicator, but to a lot of automated or mechanical signals. And that is, it can reinforce discipline. What does that mean? Well, because of its mechanical or automated nature, a trader can just have a hard and fast set of rules. Hey, I take a trade when price pops above the PSAR in an upward sloping 100 period moving average. That's a rule. And I exit that trade if price falls 1% below a trailing rising PSAR. Maybe that's their approach. It's just an example. But when we have a mechanical or an automated approach like that, it can introduce a lot of discipline and at the same time, brings us to number 5, reduce emotional trading. One common way that a trader who really struggles with handling their emotions, it could be fear, it could be greed, it could just be, I don't know, panic, whatever it is, one potential way to address that is to automate things to the fullest extent possible. Now, automating things, making things mechanical, doesn't mean that those things are always going to be profitable. But once we remove emotions as much as we can from our trading, then if we get 100 trades down the road and our approach still isn't working, we can at least go back over those 100 trades and see what's going wrong. On the other hand, if we're just having sort of knee-jerk approach to whatever is coming across the ticker at us, that's really hard to learn from and it's really hard to improve on. All right. Now, a final potential benefit is that this can be a complement to other indicators. It's a tool that can be used in combination with other tools, and very commonly it's used with a simple moving average. But you might be asking, hey, Cameron, could I use this like with a whole moving average? Somebody already asked about that. Could it be used with the MACD indicator that we've used in our TVM strategy set? Conceptually, could be. But using an individual indicator in isolation can make it, it can be very likely to generate what we call whipsaw signals. And it can sometimes be useful to use a combination of 2 or maybe 3 indicators to try to reduce whipsaws. And this is one of those indicators that some traders will use for that purpose. So yeah, building it into a system and combining it with other indicators may help to reduce exposure to whipsaws. So these are all potential benefits. Are they guaranteed to work every time? Of course, they're not guaranteed to work every time. But now that we know how this is built, we understand how it might be used. We can actually look at how's it done through the rest of the year. Here's an entry here. Ran up. I don't think we ever got 1% below the highest dot there before it took off again. This one would have ended and then restarted again. Probably another good trade right there. Oh, this gap. Ooh. Yeah, gaps are tough. Maybe these 2 candles up here at the top nicked our trader out just in the nick of time, or that maybe that gap caught him. Ed says TVM series. Yeah, Ed, if you didn't catch that earlier in the webcast, I talked about TVM. And if you need to go to the archives on our Trader Talks channel, you can find that TVM. But looks like our most recent entry signal, look at this. Price is below our moving average, but the moving average is upward trending. Yes, to a PSAR trader, this would still be considered to be a potentially legitimate entry signal, even with price below that moving average. If the trend line is still upward sloping, they might still take an entry here, and that one's still working. So I do want to place a trade. Let's pop over here to AT&T. Here's another stock, upward trending. It actually just had an earnings announcement, so that's now in the rearview mirror. But price strengthened over the few days, actually leading into that earnings, enough to cause that parabolic stop and reverse of signal. So our 2 most recent dots are below price. We are upward sloping in our trend line. Let's go ahead and take our trade. And as I do that, let's actually save this. Actually, let's do it this way. It's not a drawing. Let's save this as a study set. And this is going to be our AT&T, just the symbol T, PSAR. Oh, and 100 SMA. There we go. Let's save that. So next time we revisit this trade, we can just load up that study set and we'll know the logic of the trade. Well, let's go buy some shares. Now, in this webcast series, we typically invest about $5,000 into each trade. 100 shares would be $2,600. Let's do 200 shares. So let's click on our ask price. And one other thing that we can do Where is our current PSAR value? Current PSAR value is at 25.15. That would put our stop at 24.90, 25 cents below 25.15. So let's put our stop in at 24.90. Let's go to our trade tab. Right click on the ask price. Let's put in a custom buy order with a stop attached. We're going to buy 200 shares. We'll only sell those 200 shares if, for right now, if price falls down to 24.90. We'll make that stop order good till canceled. There we go. Now, in the interest of trying to get a quick fill, I'm going to switch this to the market order. But of course, as we click confirm and send, there's a reminder here that says with market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. So we might think that we're about to buy this for $26.69. It could be more than that. Now we have a stop in at 24.90. With stop orders, there's no guarantee that the execution price will be equal to or near the activation price. In this case, that would be the 24.90 level. But in any case, buying 200 shares of T at the market price, selling those with a stop of 24.90, good till canceled. No commission on this trade, but there can be on some types of trades. And we'll send that order off. And we bought it. Hey, look at that, right at 26.69. Everybody, we've done it. We've introduced ourselves to this new indicator. We've gone through 6 different ways that the parabolic stop and reverse might help a trader in just their understanding of a stock chart. So I hope you enjoyed this discussion. Yeah, if you want to see the parabolic stop and reverse in greater detail, let me do this for the live attendees. I'll just put a link to that other PSAR webcast. And I've shown everybody else how they can go find it on YouTube. There we go. There's that parabolic stop and reverse link at my other webcast where I went into the construction of the indicator in a little more detail. But it's time for me to let you go. I'm going to be headed off on vacation for a few weeks, so I won't be seeing you for a little while, but we'll have other coaches that are going to be filling in. They're always fabulous. You know they are. Kevin, thanks for helping out in chat. But everybody, just remember, if you haven't subscribed to our Trader Talks channel yet, do that. It only takes a second. Go down, click on the subscribe button under the video stream. Doesn't cost anything, takes a second. But this is where we house our playlists of our previous webcasts. You can join our live streams. Also, make sure that you're following your favorite presenters on X. I'll be giving you updates. You'll notice what's in the background here. Yeah, I'm going away to Scotland for a few weeks, and that's what's in the background here of my X account. But I'll be back in a little while. But in the meantime, I will be posting on X. It's the only place you're going to hear from me for the next few weeks. So if you're not following me there, I'll be pretty quiet. But yeah, you can follow Kevin here at Kevin Horner CS. You can follow me on X at Cameron May CS. Just make sure that you're precise with those handles, because there can be similar ones on social media. You want to make sure that you know who you're dealing with. All right, everybody. Thanks for all the thumbs up. I can see 168 people watching right now. Looks like as of this moment, 50. I've already clicked the like button. That's definitely appreciated. If you enjoy one of our webcasts, make sure you click the like button. It's an applause for your presenter, and it gives their webcast a boost in the YouTube algorithm and helps more people learn about things like the parabolic SAR. Guys, I'll see you in a future webcast in a few weeks. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.